big week. The market ripped higher, oil cracked, and the portfolio just put up its best week in months. I'm going to walk you through what happened and why we remain bullish. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free. You don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Okay, let's start with the scoreboard. Here are the numbers. Now, let's look at the broad market. 4 main buckets to know. The S&P 500 is the 500 biggest U.S. companies. That's ticker SPY, up 4.5% this week. The equal weight S&P gives every company the same size seat at the table, ticker RSP, up 3.3%. The NASDAQ 100, heavy on big tech, ticker QQQ, was up 6.2%. And small caps, the smaller U.S. companies, ticker IWM, gained 5.5%. 4 things to notice. Tech led, small caps kept up. Equal weight trailed, which tells us the biggest names did the heaviest lifting. And the NASDAQ is up almost 47% over the last year. That is not a one-week fluke. That is a real trend. Let me break those 4 points down. First, big tech led the rally. AI and cloud companies drove the tape. Second, small caps did not get left behind. That matters. When people are scared, they sell small caps first. They didn't this week. Investors were willing to own risk again. Third, the equal weight index trailed. That tells us the Magnificent Seven, the biggest tech names, did the heaviest lifting. The rest of the market is starting to catch up, but it's slow. Fourth, the 12-month gain on the NASDAQ is 46.8%. Whatever happens next, we are building on strong ground. Look at the sector chart. Technology up 8.2%. Consumer discretionary, the stuff people buy when they feel rich, up 6.7%. Communications, which includes Google and Meta, up around 4.5%. Industrials up. Financials up on strong bank earnings. Now the losers. Energy down 3.4%. Utilities down 1.7%. This is what we call a textbook ceasefire tape. When the war fear goes away, the sectors that got hurt by high oil and high risk, tech, retail, travel, those jump higher. And the sectors that got a boost from war fear, energy and safe havens like utilities, give back. That is exactly what happened. No surprise in this picture at all. Zoom in one level, and the picture gets clearer. Software was up almost 14%. Clean energy up almost 9%. Internet up 8%. Airlines up almost 8%. Semiconductors up 6%. Why airlines? Cheaper jet fuel. Why software? A famous value investor named Michael Burry publicly bought software names after they sold off. That broke the fear. On the losing side, oil drillers down 5%. Oil services down 2%. Same story. The war premium that was in oil prices is coming out. This is not random. Every move this week tells the same story. A ceasefire, a relief rally, and smart money stepping back into risk. Okay, now let's talk about the big picture. Why is the economy holding up so well? I want to share the work of Ed Yardeni, a veteran economist we've followed for decades. Yardeni published 3 notes this week. His theme, the stress tests keep getting passed. Number 1, foreigners bought $1.35 trillion of U.S. stocks and bonds in the 12 months ending this February. Every story you've read says capital is leaving America. The hard data says the opposite. The world is voting with its money, and the vote is America. Number 2, jobless claims dropped to 207,000. That's the lowest 4-week average since June 2024. Companies are not laying people off. Number 3, the Philly Fed Factory Survey just hit its highest reading since 2021. U.S. manufacturing is picking up. Yardeni's bull-bear ratio flipped from 2 bullish before the war to 2 bearish at the March 30th bottom. That's the classic contrarian signal. And it's not just the data. Listen to the banks. Jamie Dimon at JP Morgan called the economy resilient. He said consumers are still earning and spending. David Solomon at Goldman Sachs called this a constructive soft landing scenario. Jane Fraser at Citi called 2026 an exceptionally strong start. Ryan Moynihan at Bank of America said client activity is healthy and asset quality is stable. These are the 4 biggest banks in America. They see every paycheck, every credit card swipe, every mortgage. They all just said the same thing. That is rare, and it matters. Here's the other side of the story. And this is where it gets interesting. Jim Paulson, another economist we respect, calls this the great disconnect. In the fourth quarter of 2025, corporate profits rose at a 26.3% annual pace. Huge number. But jobs only grew 0.4%. For all of 2025, corporate earnings grew almost 11%. Payroll growth was basically zero. Since the end of 2019, the US economy has grown 43%. Corporate profits have grown 73%. How? Margin expansion. Companies are making more money per dollar of sales than ever before. The S&P 500 profit margin is near 14%, a post-war record. Tech margins are close to 30%. Meanwhile, consumer sentiment just dropped to 47.6. That's a post-war record low. People say they feel terrible, and yet they keep spending. So we've got record profits, almost no job growth, and miserable feeling consumers who won't stop swiping their cards. Here's what both economists agree on. The facts. Profits are at record highs. Job growth is near zero. Consumers feel bad, but keep buying. Prices are up. Wholesale inflation hit 4% year over year, a 3-year high. The Fed is unlikely to cut rates again in 2026. Foreigners keep buying U.S. assets at a record pace. And the Atlanta Fed's current estimate for first quarter growth is 1.3%, below what economists call stall speed. So both men see the same economy. They just worry about different pieces. Yardeni is focused on resilience. Paulson is focused on fragility. Both are fair. The question is, which story wins? Here's how we read it. On one side of the scale, the uncomfortable stuff. A nearly frozen job market. Low consumer mood. A wholesale price spike. Weak GDP growth. On the other side, the bullish stuff. Record profits. Record household net worth. $1.35 trillion of foreign money pouring into America. A big tax refund bump from the 2025 tax law. Our view, AI is driving a real productivity reset inside American corporations. That's why margins are at records. That's why profits can rise even when payrolls are flat. This is a structural reset, not a late cycle economy running out of gas. That is why we're structurally nervous, but tactically bullish. We respect the risk. We see the fragility. And at the same time, we believe the businesses we own are exactly the ones that benefit from what's happening. Record margins flow to the best companies. Now, geopolitics. Gulf War III started on February 28. The S&P sold off. Oil jumped 35%. Inflation spiked on higher energy prices. Then came the turn. On April 7th and 8th, the United States and Iran agreed to a 2-week ceasefire. Oil started falling. The market started climbing. As of April 17th, the S&P 500 is 1.3% above where it closed the day before the war started. Think about that. A full war happened. Oil spiked 35%, and the market ended up higher than when it started. This is the 8th or 9th time in modern history that a geopolitical panic turned into a buying opportunity. Smoot-Hawley, Pearl Harbor, the Cuban Missile Crisis, Gulf Wars 1 and 2, 9/11. The long-term compounders don't care. That's the pattern. Here is the core of why we stay bullish. The world is opening up. Ceasefires are narrowing, not widening. Gulf War III ended. Ukraine is cooling. Red Sea shipping disruptions are fading. Every one of those frees up real economic bandwidth. Trade flows are normalizing. Tariff pressure is residual, not growing. The reshoring of AI data centers, chip plants, and energy infrastructure is adding jobs and capacity. Foreign capital is choosing America. That $1.35 trillion number is not a rejection of global markets. The world is pouring capital into the most productive, most protected, and most transparent market on Earth. Emerging markets are opening back up, which helps our global names like LVMH, Novo Nordisk, Eli Lilly, and ASML. Open economies are the best backdrop for the businesses we own. Let me close the big picture section with Francois Rochon. He runs Giverny Capital. Since 1993, he's compounded at 13.4% a year after fees, beating the S&P by almost 3 points a year. So he earned the right to speak. He said 3 things this week that matter for us. 1, on AI. He called it a revolution as big as the internet 30 years ago. But he warned, NVIDIA invests $100 billion in OpenAI. OpenAI signs a $300 billion contract with Oracle. Oracle then buys $40 billion of chips from NVIDIA. That money runs in circles. We should not pay permanent multiples for 3-year contracts. 2, on Google and Meta. We own both. Rochon calls Alphabet spending defensive, protecting its search moat. He calls Meta spending offensive, sharpening its ad targeting. Both are right calls for different reasons. 3, on temperament. He said, it is not a sprint, it is a marathon. His 3 traits for long-term investors are rationality, humility, and patience. That's the posture we want you to adopt this weekend. The market rewarded patience this week. It almost always does. Next week is earnings week, and several of our names report. Tuesday, April 22nd, Tesla, ServiceNow, and Medpace. Wednesday, April 23rd, Roper, Kinsale, and Thermo Fisher. Tuesday, April 28th, S&P Global, NXP Semiconductor, and General Motors. Wednesday, April 29th, is the big one. Alphabet, Amazon, Microsoft, and Markel all report the same day. We also get fresh economic data, existing home sales on Tuesday, flash PMIs on Wednesday, durable goods, and consumer sentiment on Friday. These reports will tell us whether the soft landing story holds. Let's talk paths ahead. The bull path. The big AI companies confirm their spending plans. Tesla beats a low bar. The ceasefire holds. Oil drifts lower. Inflation surprises to the downside. Breadth continues to broaden. In that case, the S&P 500 tests 7,700 by summer. That is your Denny's target. The bear path. The Gulf ceasefire breaks down. Big tech disappoints on guidance. April inflation runs hot. First quarter GDP confirms sub 1.5% growth. In that case, we get a 3 to 5% pullback. Here's our view. If we get the bull path, great. If we get the bear path, we treat the dip as opportunity. We are not trading around headlines. We are owning companies for years. Any pullback just gives us better prices on the names we already want to own more of. Now to our portfolio. Our 5 best weekly performers. ServiceNow, up 16.5%. ServiceNow builds software that runs the back office for large enterprises. IT, HR, customer service. It had a rough first quarter. Michael Burry's public buying broke the fear. The company reports April 22. Tesla, up almost 15%. The stock jumped on a chip milestone and an analyst upgrade. Tesla is repricing as more than a car company. It is an AI robotics platform with a massive energy storage business. We own the optionality. Microsoft, up 14%. Roshan called Microsoft easier to value than NVIDIA because subscription revenue is recurring and predictable. Azure is the main AI engine. Earnings hit April 29. AMD, up 13.6%. AMD makes AI chips that compete with NVIDIA. Hyperscalers want a second supplier. AMD is it. And AMD is already up 30% for the year. KKR, up 13.6%. KKR runs private equity, real estate, infrastructure, and private credit. The bank's CEOs eased fears about private credit this week. KKR was oversold coming in. We treat this drawdown as a window, not a warning. 5 names, 5 real businesses, 5 different reasons to be up. That is what a well-built portfolio looks like when it works. Now the 5 names that lag. And I want to be clear, nothing went badly wrong. Permian Resources down 6% for the week. It is still up 38% for the year. This was the ceasefire trade. When oil falls, pure-play drillers fall first. Diamondback Energy down 4%. Same story. Same ceasefire trade. Still up almost 20% for the year. Nothing changed in the business. Merck down almost 2%. It is up 13% for the year and over 50% the last 12 months. Big Pharma took a breather while money rotated into software. No company news. Eli Lilly down a little over 1%. Still up 10% over 12 months. Lilly is our GLP-1 anchor. Mounjaro and Zepbound are rewriting diabetes and weight loss. Earnings hit April 30th. Pre-earnings caution is normal. ASML down a little over 1%. The lithography monopoly reported a strong first quarter, but guided 2026 revenue conservatively. Year to date, it is up 36%. No position changed. No thesis broken. When a risk on tape gives you minor pullbacks in 5 defensive names, that is not bad news. That is healthy rotation. Zoom out. The VAP this week, up 5.64% gross, 5.62 after fees. Year to date, up 0.75% gross, 0.3 after fees. 12 months, up almost 40% gross, 38.3 after fees. Total portfolio value, $962,044 across 35 names. For reference, the S&P 500 is up 36.5% over the last year. The equal weight S&P is up 27. We are right with the benchmarks and ahead of the equal weight, while owning fewer than 1% of their companies. That is concentration with discipline. 3 things to take away from this weekend. 1. The V-shape is real. Every geopolitical shock in the last century has looked like a catastrophe on the way down and an obvious buying opportunity on the way back up. Gulf War III is no different. Clients who held on March 30th got paid this week. 2. The paradox resolves in our favor. Yes, the economy runs on margin expansion, not broad growth. Yes, jobs are nearly frozen. Yes, sentiment is at a record low. And at the same time, profits are at records. Banks are lending, foreigners are buying, and the businesses we own are exactly the ones benefiting from the productivity reset. 3. Own compounders. Be rational, humble, and patient. You don't need to time ceasefires. You don't need to guess earnings. You need to own the right businesses and stay owners. That is what the value-aligned portfolio is designed to do. The war was over this week in the only way that counts, in the prices of the companies we own.